Build Wealth the Boring Way, a practical, tier-by-tier guide to investing for real people. If you remember nothing else from this article, remember this. Saving alone won't make you rich, but investing can. The average savings account pays about 0.57%. Put $10,000 there for a decade and you'll wind up with around $10,584, a whopping $584 gain after 10 years. Meanwhile, the stock market has historically returned about 10% annually before inflation, closer to 7% after inflation. Over long periods, that difference compounds into a completely different life. Investing is not about adrenaline. It's not about perfectly timing tops and bottoms or winning your way to freedom day trading on your phone. Real investing is automated, diversified, and boring, and that's exactly why it works so well. Below, you'll find a complete, step-by-step plan for 3 common income tiers, $25K, $60K, and $100K plus, with clear priorities, account choices, and realistic actions you can take this week. You'll also learn how to think about big levers like employer matches, HSAs, fees, and the 4% rule, plus how to align your money with the life you actually want. Investing, demystified in one paragraph. Investing is using your money to make more money automatically. You buy broadly diversified funds, like an all-in-one target date fund or a handful of low-cost index funds, and keep buying them on a schedule, rain or shine. Your dollars go to work in thousands of companies, your dividends are reinvested, and time does the heavy lifting. No day trading, no obsessing, no text alerts that hijack your emotions, just a system that compounds while you live your life. The 2 pillars, automation and diversification. 1. Automate everything. Set up automatic transfers, 5 to 15% or more, of each paycheck into your investment accounts, 401k, Roth IRA or traditional IRA, HSA if eligible, or a standard brokerage account. Set it and forget it is not laziness, it's a feature. Automation protects you from forgetfulness, fatigue, and the impulse to spend. Critical reminder, money that lands in an investment account is not invested until you tell it what to buy. Choose your funds and set auto-invest so the cash doesn't just sit there. 2. Diversify on day 1. Do not put all your money into a single stock, no matter how hot it seems. That's speculation, not investing. A target date fund gives you instant diversification across stocks and bonds and becomes more conservative over time. Alternatively, build a simple 3-fund portfolio: total U.S. stock, total international stock, total bond. Either path is fine. Consistency beats complexity. Tier 1, earning about $25K, or tight budgets up to about $40K. If you're living paycheck to paycheck, it can feel like investing belongs to some other universe. I get it. At this level, you have 2 immediate priorities. Priority number 1, build your financial moat, an emergency fund. Start with 1 month of basic expenses: rent, groceries, transportation. Then methodically grow to 3 months. Eventually 6 if your job is unstable or you have dependents. Keep this in a high-yield savings account, not the market. The goal is resilience. With a cash buffer, a car repair is an inconvenience, not a catastrophe that forces credit card debt. Priority number 2, begin investing even if it's just $20 a month. Why bother with $20? Because time is your best friend. Kevin invests $20 a month starting now and keeps going for 30 years. Sasha waits 10 years, then invests $20 a month for 20 years. With the same 7% real return assumption, Kevin's balance after 30 years is roughly double Sasha's. The difference isn't hustle, it's time in the market. If 10% of your take-home pay isn't realistic yet, start at 2%. Then set a calendar reminder for December 15th to bump your rate by 1%. Repeat annually. The small steps you actually take beat the perfect plan you never start. The conscious spending plan. Adapt it to reality. 50 to 60% fixed costs. Rent, utilities, debt minimums. 5 to 10% savings goals. Emergency fund until fully built. 10% plus investments. Start smaller if needed and ramp up. 20 to 35% guilt-free spending. Yes, even on a tight budget. If your fixed costs are 70 to 80%, don't quit. Customize. Trim guilt-free spending to 10% temporarily and channel the difference toward your emergency fund. When the moat is built, redirect that cash to investments. The tough love that pays. You can influence your income, not overnight, not by magic, but by developing skills, building a network, and creating side income. $200 to $500 a month helps a lot at this tier. Treat earning more like a skill you practice on purpose. Better resume, targeted applications, certifications that matter in your field, and a simple side gig that solves a real problem for a real person. Tier 2. Earning about $60K. At around $60K, your take-home is around $4,100 per month. Varies by location and taxes. You have a little more room to breathe and to let compounding work. Target investment rate. Start at 5% and climb. If 5% feels high, student loans, high rent, start at 2 to 3% and auto increase by 1% each year. This alone can add hundreds of thousands of dollars to your future. Don't leave free money on the table. 401k match. If your employer offers a match, prioritize contributing enough to capture all of it. A simple illustration. 3% of $60K invested annually for 30 years at 7% real, around $175K. With a 3% employer match, roughly double, since you're effectively investing 6%, around $350K plus. It's not exact because of timing and returns, but the point stands. Matches are powerful. If you don't have a 401k, open an IRA. Roth IRA contribute after-tax dollars. Withdrawals in retirement are tax-free, subject to rules. Traditional IRA, contributions may be tax-deductible now, withdrawals taxed later. The secret weapon few use, HSA, if eligible. With a high-deductible health plan, you can contribute to an HSA. Pre-tax contributions, lowers taxable income. Tax-free growth on investments inside the HSA, tax-free withdrawals for qualified medical expenses. That's a triple tax advantage. Many people pay expenses out of pocket now and let their HSA grow invested for decades, then use it tax-free in retirement for health costs. Focus on $30,000 decisions, not $3 habits. Cutting lattes won't move the needle. These will. Capture your 401k match, auto-increase your investment rate each year, negotiate your salary, one raise can be worth tens of thousands over time, build marketable skills with real ROI, avoid high-fee funds or advisors that shave 1% or more off your returns every year. Zoom out. What's the money for? Pick a few medium-term goals. Wedding, down payment, kids' education, sabbatical. Match the account to the timeline. Money needed in 1 to 3 years, stay safe. High-yield savings, CDs. Money for 5 to 10 plus years goes to a diversified portfolio. If you want help, a flat-fee planning service can be great, especially one that covers taxes, retirement, and estate planning. At $100K, your take-home might be around $6,500 per month. Varies. Income brings opportunity and temptation. Systems protect you from lifestyle creep so your net worth keeps accelerating. Clarify your money dials. Money dials are categories you love to spend on. Travel, food, fitness, convenience, experiences, generosity. At higher incomes, you can turn up 1 to 2 dials a lot and turn others way down. There is nothing wrong with spending lavishly on what you love if you are on track to hit your long-term goals. Be intentional, not apologetic. Invest by percentage, not dollar amounts. Commit to at least 10% of take-home invested. 15% plus is better. Percentages scale automatically as your income rises, pushing more dollars into compounding without you thinking about it. Max out the tax advantage stack. 401k match first, always. Roth IRA, if eligible, or traditional IRA. Backdoor Roth IRA if your income is too high for a direct Roth. Understand pro rata rules. HSA, if eligible. Additional 401k contributions beyond the match. Taxable brokerage. Unlimited contributions, extremely flexible. Automation flows your money through these in order every paycheck. Fees are a 4-letter word. Consider 2 investors both starting at $50,000 at age 30, adding $1,000 per month for 35 years, earning 7% real. Low-cost index funds, 0.20% expense ratio, ends around $2.0 million. Add a 1% advisor fee, ends around $1.7 million. That's roughly $300K to $400K lost to fees and compounding on those fees. If you hire help, prefer flat fee planners or advisors whose incentives align with yours. Buy versus rent. Do the math, not the myth. Home ownership can be great, but it's not automatically superior. Before you buy, run a rent versus buy analysis that includes mortgage principal and interest, property taxes, insurance, maintenance and repairs. Rule of thumb is 1 to 2% of home value annually. Transaction costs, closing costs, realtor fees, opportunity costs, what your down payment could have earned in the market. If you buy, you're buying for life fit, schools, stability, customizations, not just spreadsheets. If you rent, you're buying flexibility. Either can be the right move. The 4% rule, a quick way to sanity check your trajectory. A quick way to sanity check your trajectory is the 4% rule. Add up your annual spending and divide by 0.04 to estimate a portfolio goal. Spend $80,000 per year, target portfolio approximately $2 million. Spend $50,000 per year, target portfolio approximately $1,250,000. It's not a guarantee, it's a guide. Your actual number may be higher or lower depending on future work income, Social Security, housing costs, healthcare, and risk tolerance. But having a target helps you choose an investment rate today that gets you there. Account setup, the simple default that wins. If you want minimal decisions with maximum odds of success, use this default. Open the right accounts. Workplace plan, 401k or 403b, Roth IRA or traditional IRA, HSA if eligible, additional 401k contributions beyond the match, taxable brokerage, unlimited contributions, extremely flexible. Pick one diversified fund, a target date index fund aligned to the year you'll be 65 to 70 or to your risk profile. If your 401k lacks good target date options, use the 3-fund alternative: total US stock, total international stock, total US bond. Automate contributions every payday. Start with a percentage you can sustain, then auto increase annually. Turn on automatic reinvestment of dividends and capital gains. Do nothing dramatic when markets swing. Keep buying according to plan. What to do this week? Tier-specific checklists. If you're around 25k, open a high-yield savings account. Start an automatic transfer toward 1 month of expenses. Start investing something, even $20 a month, in a Roth IRA or work plan if available. But a calendar reminder for December 15th, increase contributions by 1% or another $10 to $25. Pick one income lever, skill course, certification, side gig, and set a 30-day milestone. If you're around $60,000, make sure you're capturing the full 401k match. If there's no 401k, open a Roth IRA and set monthly auto contributions. If eligible, open an HSA and invest the balance once a cushion is in place. Set an auto increase in your contributions every year by 1%. Choose one big money move to execute in the next 60 days. Salary negotiation, job switch, certification with ROI. If you're 100k plus, commit to 10 to 15% of take-home invested, automated. Max the match, fund Roth, traditional or backdoor Roth, HSA if available, then taxable. Audit fees. Switch to low-cost index funds, less than 0.20% expense ratios wherever possible. Run a rent versus buy analysis if you're contemplating a home purchase. List your money dials and intentionally turn up 1 to 2. Turn others down. Align with your partner if applicable. Common mistakes that quietly cost you 6 figures. Leaving cash idle in an IRA or 401k. Set auto invest into your chosen fund. Chasing hot stocks. Concentration magnifies risk. Diversify instead. Waiting for the perfect time. The market rewards time invested, not perfect timing. Paying high fees. A 1% annual fee can cost you hundreds of thousands over decades. Letting lifestyle creep outrun income. As you earn more, keep your percentage invested high. Ignoring taxes and accounts. Learn the basics of Roth versus traditional HSA and taxable, it's real money. Confusing entertainment with investing. CNBC is noise, your IPS, investment policy statement, is signal. A simple investment policy statement you can steal. Write one page that says, goal, retire at 60 with X, fund college at Y, annual travel budget Z. Asset allocation, 90-10 stocks bonds while under 45, glide to 70-30 by 60 via a target date fund. Accounts in order, 401k to match, Roth IRA, HSA, extra 401k, taxable. Contribution rule, minimum 10% now, increase 1% annually until 15% plus. Rebalancing, annually every January via new contributions or let the target date fund do it. Behavioral rules, no selling based on headlines. If market falls 20% plus, increase contributions if possible. Fee ceiling, all funds less than 0.20% ER, no AUM advisor greater than 0.30% unless unique, quantifiable value is proven. Print it, sign it, follow it. FAQ-style speed round. What if I have high interest debt? If your credit card APR is 16 to 25%, attack it aggressively while still capturing any 401k match. Free money beats most debts. After the match, throw extra at the highest APR. Target date fund or index fund trio. Whichever you'll stick to. Target date is one decision simple. If you like a bit more control and lower fees, the 3-fund approach is great. How much cash should I hold? Emergency fund, 3 to 6 months, plus near-term goals, 1 to 3 years, in cash-like vehicles. Everything for 5 to 10 years? Invest. Is now a bad time to invest? Over a 30-year horizon, the single most important variable is being invested. Set your allocation and automate. I'm afraid of a big crash. Crashes are normal. Your defense is diversification, time horizon, and behavioral discipline. Keep buying according to plan. The boring ending that changes your life. When you automate contributions, use diversified funds, avoid dumb fees, and keep buying through thick and thin, your money grows quietly in the background, while you're at work, on vacation, or asleep. That's not hype, it's math. At $25K, your job is to build the moat, start tiny, and grow the habit. At $60K, your job is to capture the match, escalate your rate annually, and make $30,000 decisions. At $100K plus, your job is to scale the same simple system, keep fees low, and align spending with your richest life. Investing should be calm. It should feel almost boring, and decades from now, when your accounts are multiples of what you ever thought was possible, boring will look like the most exciting decision you ever made. Action in 15 minutes. Log into your 401k, IRA, or brokerage. Choose a target date fund or a total market index trio. Turn on automatic contributions from your next paycheck. Put a reminder on your calendar to increase the rate by 1% on December 15th. That's it. Simple doesn't mean small, it means repeatable. And repeatable is how ordinary people build extraordinary wealth.